Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. And we are looking at how global growth may be slowing, but it's far from standing still. Citi's latest CIO outlook dives into how policy shifts from U.S. tariffs to immigration tightening are reshaping markets and trade flows across Asia. With the U.S. dollar softening and China's recovery showing mixed signals, what opportunities and risks lie ahead for investors? We'll unpack Citi's take on currency trends, the AI era, and what a resilient 60-40 portfolio looks like in this new, more volatile cycle. And helping us out this morning, Peng. He is the head of Asia Investment Strategy for Citi Wealth. Ken, good morning. Happy Friday.
Good morning. Happy Friday indeed. Thank you for having me.
Yeah, great to have you on because it's very interesting times, especially as you look at all the issues playing out. How optimistic are you right now when it comes to where the economy is going, where the markets are going for the rest of the year?
Well, look, I think there's parts of the economy are doing well, parts of the market are doing well, other parts are not struggling, right? So you do have this dichotomy of this divergence of direction for this. For example, like the consumer sector is likely to be under some more pressure, right? Employment is weaker and likely to weaken further, but the tech-related and the financial sectors, because of AI advances and an interest rate curve steepening, they're likely to do better. Right, so you have that divergence happening, and I think the power of the positive growth sectors is more dominating at the moment, and hence the market is still well supported.
Yeah, talking about the markets, you've described it as being K-shaped. What do you mean by that? And also, how does technology fit into the outlook going forward?
Well, first on the macro side, right? So you look at the U.S., the economy is still growing. We're not expecting a recession, but what we are seeing is shrinkage in employment. And a lot of this has to do with immigration tightening, with tariffs hurting the manufacturing sector, and the whole DOGE thing that caused government layoffs and now shutdown, right? So the employment numbers when we eventually get them, it's probably not going to look good. That's going to pressure consumer sentiment, which is already on the floor, and consumer spending has been more resilient than sentiment indicators, but I think that's probably slowing down as well. So essentially on the consumer side, right? Actually, this is not just the U.S. You have similar things happening in, say, China or even Europe, and so the consumer complex across the globe is struggling. So now on the tech side, of course, right? So you have the AI advancements, massive amounts of capex is still being spent. The overall tech sector has tech leaders, right? The major platforms, the model builders, they have a lot of cash. They have a lot of free cash flow. They don't need to borrow. They don't need to raise equity capital to invest into AI. Some of them do, but big ones are pretty solid in terms of financing it with their own free cash flow. So you're likely to see more significant capex numbers for years to come, right? So I think yeah, the valuations are high, but I don't think they're crazy. And they're supported by reasonably solid fundamentals. So I think that dichotomy, you have the tech, financials as well, right? Because of the expectation for lower interest rates, more capital market activity. So all these things are helping banks and financials in general. So these two, maybe a little bit of healthcare, are on the upper leg of the K, whereas consumer and I think some industrials are on the lower leg of the K, and that's why we call it a K-shaped economy.
All right, for an Asian investor investing in U.S. markets, part of the equation is going to be the currency effect. And with the U.S. dollar in focus, we've seen it weaken to some extent significantly in the past year. And that comes with all the issues around what's playing out with the fiscal deficit and now the U.S. government shutdown. What should investors be thinking about when they invest with this current FX backdrop?
Yes. So essentially with regards to the U.S. dollar, right? The collection of President Trump's policies are essentially trying to make the U.S. exports, U.S. manufacturing more competitive. Right? That hasn't really happened yet, but the reason it hasn't happened is because the exchange rate with the CNY, or the Chinese yuan, hasn't moved much. The euro has appreciated versus the dollar by about some 14% this year so far, and that's massive. But the key trade imbalance is not with Europe, it is with China, right? So without adjusting the renminbi exchange rate, U.S. manufacturing, it's harder for the U.S. manufacturing to become more competitive. So I think this is going to be the next leg of potential U.S. dollar weakness. So all this is very intentional, right? I think the deficits, the trade deals, the tariffs, all these things have kind of disrupted the flow of capital that had previously benefited the U.S. Right? Previously the regime is all the exporters, they export to the U.S., they earn U.S. dollars, and then they invest those U.S. dollars back into the U.S. in bonds and equities. So that helped to support a lower interest rates and higher valuation. But now that flow of capital from trade has been disrupted, and I think that's why you're seeing the U.S. dollar remain on the weak side for quite some time, and probably will continue into next year. And I think the next catalyst is going to be if U.S. and China make a trade deal, and part of this deal will probably involve a stronger CNY. And so I think this is, a lot of Asian currencies, I mean, Aussie dollar included, right? So a lot of these currencies, exporter currencies, have been subdued because the CNY hasn't moved as much, right? CNY appreciation is likely to lead to a stronger, broader Asian currency space. Yeah.
So we've got a bit of a backdrop of weaker growth, political shocks, and lots of issues on the table. So in terms of a portfolio allocation, what should investors be doing to just make sure they are holding on to a resilient, maybe 60-40 mix? What would that look like? How much of that goes into China? How much of that goes into the U.S.?
Okay, this is a great question. So I think the 60-40 still makes sense, but I think we want to make it a little bit more reflective of the uncertainties in terms of policy and markets that we experience currently, right? So I like to call it a 2-2-3-3. The first two tools are secondary market equities, right? So basically split evenly between U.S. and non-U.S., right? Each 20%. And within the non-U.S. slice, you probably should have 3 to 5%, depending on where you are in terms of China. And if you're a Asia bias investor, you can probably have double that. And then the first three is fixed income, right? So we still think that intermediate duration investment grade fixed income generates sufficient income, significant income for you, for the investor, and also it stabilizes portfolio returns. And then finally, the last three is alternatives, right? I think this will include hedge funds, private assets, whether it's credit or equity, and a little slice of commodities, right? So I think these are portfolio diversifiers, right? So we see them as providing low correlation or uncorrelated returns to secondary markets, and I think that's a very important slice of your portfolio in this environment.
All right, 2-2-3-3 is the approach. Been in conversation with Peng. He is the head of Asia Investment Strategy for Citi Wealth. Ken, thank you so much for your time and insights this morning.
Thank you.
Great chatting with you. Have a great weekend as well. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.